Hello everyone, and today we are going to talk about how to evaluate the business. I'm going to give you evaluation in 7 steps. Step number 1, do you understand the business and industry? So you need to decide before you invest in some company. Do you really understand what business is about? What product they produce, why they produce that, and what value it brings to the customers, which is the most important. In this question, you can also ask yourself, will this industry and business grow in the future? Do you see the potential? Do you see this product bringing value to the people in the next 20 to 100 years? That would be a worthwhile question to ask if you want to invest in the company. Question number 2, outstanding management. Outstanding management is extremely important for successful business in the long run. So you need to ask yourself if this management you're investing in is integral. Do they really pursue the value, and do they really think about their business as something what is long term, what is not just a short term cash cow, but a real legit business where they want to bring value to the people. So you can check their integrity by reading certain articles about the scandals they were involved in. You can check Glassdoor, where you will find employees' reviews, or maybe you know some employees who were working in this company and no longer working there. You can just ask them directly if you have an access to that. So there are multiple ways you can do that. Shareholders oriented. So they are not just existing to make themselves richer. They also create value to the shareholders. It means in the long term the value of your investment will grow because the company is invested in the success of their shareholders. Financial shenanigans. So is there any signs of the fraud which this company was involved in? There are any news articles or anything you found in the balance sheet, a cash flow statement or income statement which makes you feel uncomfortable? Try to avoid companies which play with the figures, who play with the figures if you are talking about the management. Condor. You need to expect that your management is often and honest with you. So there are a lot of examples of the management who try to promote their businesses. Promotion of the business does not make business better. And one of the big examples of promotion of the business probably would be Tesla. Tesla has nothing to do with the real value. So the current level at which company trades has nothing to do with the value, but it's very well promoted. That's why the value of the company is so high. You need to expect that your management will be fair and honest with you and tell you what you should expect. And in the good times, they will tell you why business is flourishing and how they enforce this advantage for the future. And in bad times, they will tell you like it is. Why is it bad? What's going on? They need to be honest with you. Frugal. So, of course, you want to expect that your company will not spend money or waste money on these things just to boost its share price. One of the examples I can take Momo Inc., the Chinese tech company, in the fourth quarter of 2020, and they reduced their costs on advertisement because advertisement was extremely expensive. Many companies wanted to advertise their products and increase their user share, and Momo hold on that, and they did not spend money. They just left money for the later date where they can spend this money more efficiently. To be frugal, it's very important for a good business. Research and development, how company invests, what is the percentage of their revenue and net income they invest in research and development, and which new products they produce, and which new products are going to come in the next 12 months or more, and how does it look for organic growth of the company. So companies would need to always come up with the new products in order to enrich their portfolio, in order to get additional sources of cash flow and earnings. So you need to check that if your company actually has a good base to produce innovative products, especially if you're talking about tech industry. It just happens all the time that someone comes up with something new and pretty much disrupts the business model of the previous company. The right price margin of safety. I discussed in the previous video how you can calculate company intrinsic value based on discounted cash flow. So you need to make sure that the price you're buying your business for is the price you would pay if you would buy the whole business yourself. It should be the right price for the right company. And you can look at my discounted cash flow intrinsic value calculation. There are many more methods. You need to also keep in mind that you need to consider margin of safety. Margin of safety, it means if you're able to buy the business for less than it's actually worth in your eyes as intrinsic value, it's a great deal. There are not so many great deals on the market, and you probably need to come through hundreds and maybe thousands of companies to find one. But if you actually succeed finding one, that's what it's all about. You need to find a good or an outstanding business for the right price. Enduring competitive advantage. Your company, if it competes with multiple other businesses, it puts it into a position where it needs to cut its profitability, it needs to cut its earnings in order to keep its share or maybe earn a little bit more share of the business on the market. That might be very difficult if you have multiple strong competitors, and you need to ask yourself what your company does so special that this company is positioned, what is unique about the position of the company on the market, that it would allow this company to flourish in the next 10 to 100 years. Financial health. You need to look into, of course, balance sheet, cash flow, and income statement of the company. You need to make sure that there are no outstanding debt, that there are no deterioration of the earnings or assets or cash flow. So you need to deeply analyze each of these statements in order to check if the company is actually healthy and if this business is actually worth what it's worth. You cannot, of course, foresee if there is shenanigans and management plays with those figures, but that's what you need to check with respect to the management. And in company, any analytics you can find for the company in the internet or whatever sources you have your access to. Valid criticism, something you haven't looked into yet, so something you don't know. You always try to learn every day what this company does correctly or wrong. And I personally try to find as many things, as many criticism I can find about the company I'm investing in as I can, because then I can go into the facts I have in order to check if the criticism given to this company is legit, if there's something to be afraid of or something I need to look deeper into in order to understand if this criticism has a ground, and if this has a ground, what consequences for my company does it mean? What does it imply for my company in general? So you need to analyze all the information you can find, and I always try to find as many negative information as I can in order to analyze it and in order to identify what is the risk for the company based on what I found. If this risk is actual risk, and if it's actual risk, what kind of damage can it be, and if my investment is still worthwhile investment after analyzing all of that. So that's a few points I will check. There are a few more maybe I can add in another video, but those are the main I would focus on. Thank you, and see you in the next video. Bye bye.